All right, the bleeding continued today. So the lucky 2 2 2 2 2 day didn't follow through with a little bit of a bounce here today. We actually continued down to the downside now, flirting with the lows from a few weeks ago. That low of that long lower shadow, which can act as a support. So I'm going to break down what it looks like here in terms of whether or not we'll come off of those lows, how likely we are to come off those lows, what our short-term expectations are, whether or not the next rally will get us, will end this, whether the low has been set. So we'll talk a lot about that. I also wanted to take you to here to our website here really quickly. All right, because of the uniqueness behind yesterday's date, we decided that we were going to have a sale as well to take advantage of it. So we put our premium package here. You can see everything you get with our premium package, which normally is almost $3,000 for 3 years, for 22% off. We've never had a sale this big, and we never will have a sale again this big. It's simply because of the date from yesterday. It works out to be about 60 some odd dollars a month, much cheaper than the $99 a month that our monthly subscribers pay for on a plus basis, just for basically for access to our Market Outlook Live and our trading rooms. For about a third less than that, you get access to that and everything else. So quite a bit and again, the way you take advantage of that is you click on this orange button here at the top of our site, and just make sure that you use that coupon whenever you log in there. Right down here, have a coupon, and make sure you put in 22, and it's case sensitive, so 22 off right there, and that will get you signed up with that offer for our premium subscription. Today is Wednesday, February the 23rd, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator, as we always do. You can see we're actually down quite a bit below the 30-day moving average right now, more than 5.5%. We did get further. We got down to about 6.5%, 6 2/3% previously. Just for some context on how far that is, again, outside of the COVID drop, there's your fourth quarter 2018 multiple times. There's your first quarter 2018. You can see other instances here. If I go back 15 years, again, just for some context on how deep this is, you can kind of, this current level is where we're at right now. In fact, it's actually 5.67. Let me edit this. This is where we're at right now. That was the low point. This is where we're at currently. But if you kind of look, going back for fourth quarter 2018, there's your 15 and 16 levels. You can see how far down we were at the lowest points. There's a 2014. There's that was the Ebola virus and Brexit, I believe, at that point. That actually might have been over here in June. I think that was June of 16. That was when QE ended, and we had the Ebola virus kind of at the same time. You can see other instances. 2012. This is as far as down as we got. There's 2011. The first time, of course, we got further down, but by the second time, this is about as far as we got a couple of times there. So you get the picture that this is a pretty decent, outside of being in full-on bear market and at the end of a bear market, because you can see all these other instances, is about as low as we got. This is a pretty darn low level. So, again, I wouldn't be surprised if, again, we got excuse me, that's on the hourly chart. We came really close to a cluster on the daily chart. You can see we're at 22, and the other lines are down there. But we are flirting with the low point, just barely flirting with the low point on Monday. Pretty decent range, pretty extreme range today, much higher than the average at 85 points. Obviously, everything is bearish. I wouldn't be surprised if we don't get a bullish near-term bounce. That doesn't mean that we're going to go back above the 30-day moving average. I don't think we will. But I do think that we'll probably come back up towards this 23% line. Obviously, we retraced this initial move to the downside up to the 62% retracement, and now we are extending down below. If you look at the NASDAQ 100, we did get a cluster on the NASDAQ 100. We also did break below the Monday low point there. So that's a pretty significant level. You can see we are below that 23% retracement for the long-term move. If you look at SPX, remember we are not below that yet. So we are just getting to it right now. So that's a key development for the Nasdaq is breaking through here, having been already below that. Again, very bearish in the short term. Your Russell 2000 is not below that low point on Monday, though it's getting pretty close. Remember, it actually got to a lower level after that Monday, but it's pretty darn close to that Monday low too. Short-term sentiment is extremely low. Intermediate line breaking down. You can see we broke below the 23% retracement, and we're really kind of moving down here. We're not as far below the 30-day moving average as we were previously as the S&P, but remember we did get 10% below here, and that was, that's a pretty extreme level for the Russell 2000 to be 10% below. You can kind of get an idea with my cursor. That's about as low as we've been too, and some of these other corrective moves. So pretty bearish market forecast charts. Again, looking at the weekly versions, we got a cluster on the weekly chart again on the Russell 2000. So it kind of shows you again where the margin of safety is. Your S&P 500 is close on the weekly. The week's not over with yet, of course, but very bearish on the short-term sentiment. Would suggest it will probably bounce back up here in the short term. And this is the weekly chart for the Nasdaq 100, also in the process of forming a weekly cluster. And not just a daily cluster, but a weekly cluster. Remember, we're still 2 days away from this week being over with. But it kind of gives you a picture of just how bearish we've been. Again, relatively speaking, of course, because we were really bullish going into it. So being really bullish going into this, we'll put that bearishness in context. I mean, for most declines, this would be a very bearish decline. I mean, look, COVID didn't even get a cluster on the weekly chart. If you go out to some of these other pullbacks, we got a cluster in 2018, and that was it, right? That was the low point. We bounced off of it from there. In 15 and 16, we did not get a cluster. We came pretty close, but the intermediate line never did get below 20 on there. If you look at 2011, we also did not get a cluster. The intermediate line didn't even get in bearish territory. It did eventually right there, and we can't but that was about as close as we got to a cluster. Was already back up by the time the short-term settlement. So, this, relatively speaking, you look at this and you think, man, this has been a bearish move. But the difference is the rally you had going into it throws off the scale of how bearish this is. Again, we're not even 38% retraced of the COVID rally that we had, this market sentiment rally, since the last bearish weekly intermediate low point. We're not even 38%. So that kind of gives you some perspective on just how much we're down, as bearish as it looks. When you look at some of these other weekly charts like this chart, you can see we haven't even had a death cross on the weekly exponential moving averages, though we are clearly, the Hakinyashi candle is clearly below the 40-week moving average. We are now only 1% gap between those two, and that's obviously falling. Your Nasdaq 100 is breaking down today. We got the cluster going here. We're 1% gap between, obviously, bearish candles there. Your Russell already has done this, and you can see the clear bearish candle we're getting this week as well. Looking at the 3 green arrow charts, for any kind of sign that the bearish momentum may be waning, you can see that the histograms are all, we're pink shading across the board here. You got pink shading, but you also have a histogram that's getting more bearish. See, it turns less bearish when it turns gray. So we are red across the board. In fact, the Russell just got 3 red arrows. So, now it's just a question of how bearish it's going to get here. The diamonds is the most bearish out of all of these. You can see it's, got some pretty decent sized candle, almost as big as it was on this first leg lower. So we're extending right now. We are easily below the 8-day moving average on all these well below the 17-day moving average. In fact, when you look at if I remove these MACD and stochastics down here and put on the PPO instead, because it's so long term, when you look at how far away we are below the 17-day moving average, we are like 4%. That's a pretty extreme level. Again, I wouldn't be surprised if we didn't bounce up here in the short term back towards the 17-day moving average. Look at my cursor, and you can see this is about as low as we get on SPY. The Qs are 6% below. And again, you look at my cursor and you can see this is pretty low too, outside of being in full-on COVID decline. So we are well below the 17-day moving averages. When we get far below these moving averages like that, it tends to lead to bounce backs, right? Pretty short term, but pretty easy bounce backs here. Here's the 8-day moving average. This kind of give you an idea of where we are, how far. We're 4% below the 8-day moving average. That means we'll have a 4% rally. I've always told you that when you're in bearish moves, they're not all red bars. You tend to get green bars too while you're in these bearish declines. Well, we can, and big ones too, 1% or more. Well, again, we could be, if you go back to this 8-day moving average here, we can get a 4.5% rally. Now, granted, that line's dropping, the 8-day moving average is dropping, but we're 3% below the 8-day moving average on the S&P 500. That means we can get a 3% rally today off of the lows and still be right at the 8-day, and that's going to obviously change tomorrow because that green line's dropping like a rock. But I would expect we're going to probably touch that 8-day, if not the 17-day. But you see, we can touch both and still be below the point of control for the 1 year now that we've clearly broken, and still be below the 200 now that both have crossed the 200. Remember, these corrections occur in stages. IWM is already in the latest stage. The first is the price drops. The second stage is the 8 and 17-day drop. These short-term moving averages drop. The next stage is the 30-day moving average drops. And then after that, the 50-day. And that's the stages. So you notice now, SPY is just in that second stage where prices dropped, but now the 8 and the 17-day have dropped. So we can come back up to those levels and still be below in fact, probably by the time we get to the 30, it will be below the 200-day moving average. Of course, the last stage is the 50-day, and we're still not to that point yet, much less getting the 50 below the point of control. Remember, IWM, when it broke all these lines, it also broke, again, the 30 broke the point of control, the price broke the 200, the point of control, and everything else did too, and it puts everything down. And so you saw that on the S&P. You can see the Qs are just about to that last stage too, where again, the price and all the moving averages are below the point of control. So if it were to rally, it would still be below a major resistance level for the 1-year chart. It's really significant. It's not too common for us to be below a 1-year point of control. Usually we're far up above it. And we're actually now below the value area. See, the Qs are below the value. The 70% of all the volume in the past year has been above the current price. It already has been that way for IWM. The Qs are now breaking below that. It's really significant again to have most of the year's volume above us instead of below us. And then you look at SPY, and we're almost to that point. In fact, getting below the 23% retracement level would be a very significant breakdown. That's why it's like we might not do that, right? The S&P, that's going to be a pretty significant support level for the S&P. Does it mean that we'll rally back up to the point of control? I don't know, but in the short term, that's going to be a pretty significant support. In fact, I wouldn't be surprised if we don't hit it early tomorrow morning before we bounce back up into the end of the week is kind of my expectation, especially with how strong the range was today. And then you look at like the volume too, big above average range, slightly above average volume. When you look at the directional movement index, we are above 35 again on the negative indicator, below 15 on the positive. When you look at QQQ, we're well below 15 and well above 35. The ADX is rising sharply there at 32. You can see we're only at 30 on SPY and 30 on Diamonds too. IWM actually is at least, we had pulled back to 20 and it's turning up again because we're getting a new breakout on its directional movement index. You look at the RSI and the CCI for SPX, you can see at relatively bearish levels. The NASDAQ 100 is about the same there, and of course your Russell all getting into bearish territory. If you look at the Ichimoku cloud, you can see the cloud, we're all below the cloud. Back to a bearish trend again, right? So we had ended the trending move, and now we're starting a new one, above 65, below -2.5 on SPY. Not quite there yet to starting a new bearish move on IWM. The Qs never did end their bearish move. They're back to a very mature bearish move right now on the Qs, and your Diamonds have also jumped up to strong bearish levels really quickly. The diamonds have been so bullish, but it's caught up very, very quickly. If you look at the weekly versions, just barely starting, and you can see we're just getting into the cloud. You can see some of these other instances, the cloud was very skinny. The cloud's very big here because of how big the rally was. Just starting in SPY, just barely starting on diamonds and SPY, excuse me. Looking at the Qs, you can see getting closer to trend, to intermediate trend levels, and of course your IWM is already at easily established. In fact, almost well through the cloud. In fact, the bottom of the cloud will act as a support, which is actually the low point from a few weeks ago. But it's well established into its own bearish trending mode here. Looking at the Bollinger Bands, you can see we are back below the lower Bollinger Band on SPY. If you look at the Qs, we are also below that lower Bollinger Band and below the Keltner. In fact, let's take a look at the Keltner channels too while we're at it. Keltner channels, here we go. You can see we're also outside of the Keltner channel. Again, see, we had gotten inside of the Keltner channel. Now we're back outside of it. And the Bollinger Bands had gotten inside the Keltner channels. They're looking to break back out too with some more green dots. So, from this perspective, it looks like we're just starting. Like SPY just started with a green dot here. And then IWM is still in the red. In fact, its momentum is actually still bullish. We haven't broken out yet. So you can see like it actually looks like we're just kind of starting here. On an intermediate move. Doesn't mean that we can't bounce in the very short term. And any bounce we do get will be very short term, near term line only. The blue line, and I don't even think the blue line will actually get like above 80 or above 90. I think it will just like get in the bullish territory for a day or two maybe. And be looking at the whole, you can see we are clearly bearish and probably will be for a while here. Not that every day will be bearish, but that the trend will be. Obviously there'll be some bullish the near-term runs to the upside. Same thing with SPY. Look, we're nowhere near changing the direction of this, though we are well below the 20-day hold moving average, which is pretty significant. You look all the way back in the past there. I mean, that's a pretty decent level to be down. Usually we just kind of start slowing down at that point. So just kind of keep an eye on that. But clearly we are changing things or turning things around. And then there's your Qs. Looking as bearish as they are, we're well below the 20-day haul, and you can see well below the 200-day haul and extending away to the downside. In fact, when you look at how far away below the 200-day haul we are, we're 13% below that. Again, for some perspective on what that looks like from a correction standpoint, you can see the COVID drop. We were well below it there. There is here, let's do a horizontal line here at that level, 13.1. So you can kind of see as I go across, there's the fourth quarter 2018 is about as low as we got. There is 15 and 16. You notice we only got about 10% down below that 200-day haul. And then 2011, you see we only got about 10%. Same thing in 2012, and eventually at the end of 2012 too. So in fact, we haven't been this far down below it. 2010 we came close. Since we were at the worst of the bear market, you can see when we started the bear market with that first correction there in early 2008, that's about as far as we got. So needless to say, this is pretty darn low. But again, it puts into context why does it seem like we're so bearish, but we haven't dropped very much? Because the reason why is because of this, right? We finally got a new 10% or more tag on a closing basis, down to 12% now on the S&P 500. But the problem is, the reason why we still haven't really corrected yet, despite a 12% tag there, is because we're coming down from a 114% tag. That is a tremendous move. And again, it's one thing. This isn't the only time we've ever had that big of a tag. If you go back to this level, we got a 93% tag there, but it took 3+ years to get that tag, coming off of that 2011 correction low point before we had that correction. It took 1, 2, 3, and then that much and that much of that year. So about 3.5 years to get that tag. It only took essentially 1 year, maybe 1.5, 1 3/4 years to get that 114, half the time that it took to get the other one. So again, it's a big tag to say that it's a big tag first and foremost. Second, we got it so quickly that it's making any decline pale in comparison. So a 12% rally or drop, excuse me, is typically a pretty significant drop in 2018, and here at 20% in fourth quarter. It's typically a pretty significant drop. But coming off of this high, it's so far meaningless, right? The Russell 2000 is a little different story. The Russell 2000 got an 80% tag there, but it also already had a 12% drop coming off of that first. I had an 11% drop coming off of that initial one. So it already had some more meaningful declines that the S&P did not. And then, of course, now it's down 20%, and it's down to this 30. It's well past the 23% retracement and down to the 38% retracement. So you can kind of get an idea of why it's been more bearish, why it seems like it's been more bearish. And of course, it's been more sideways for almost a year. Breaking below that support level was very, very bearish for the Russell 2000. Let's take a look at volatility here really quick. And you can see, as bearish as we are, volatility is barely above 100%. In fact, when you look at that nice pattern we had yesterday, today's pattern hardly reverses that. And I still expect that we'll get some bearishness and volatility, again, in the very short term, maybe for a few days only, maybe down to the 95% mark. We hit a low point maybe by the end of the week, and then we rally to the upside, right? So that would mean that we'll have, this would be the weekly candle there. So I would expect probably by the end of the week we'll finish below 100% before we rally the week after that or more into that, again, the FOMC meeting, which is the biggest deal right now with the markets. It's kind of been on the back burner with what's going on in Eastern Europe and Russia, with Ukraine and Russia. But the reality is that's what the markets is most scared about. And that's going to be front and center here within another week or two. If you take a look at you saw the volume is above average. Both these levels are rising. We're above the 2% mark already, though we still haven't really corrected, right? The volumes are higher than they've been, but let me put some of that in perspective here. It's not as high. I mean, we've seen it higher, and you can see that 2%. We were higher in fourth quarter 2018, well higher in the COVID drop. If you take again, when we're talking like significant, not just intermediate pullbacks, but big corrections, right? We got well above 2% there, a little bit above 2% in 15 and 16, and then 2011 we got up pretty much to 3%. So that's kind of where I expect we'll be. I don't think we'll get all the way up to 6, but getting up to 3% or 2.5, 2 3/4 to 3% is definitely in the cards, especially considering that volatility still hasn't spiked, right? We still haven't spiked up to that 125. By the time this is all done, I expect this will be up to 125%. Again, by the time all the selling, the low is set in, I expect that's where this will get up to. Again, to show you those past, those same levels, there's 2018, the fourth quarter 2018, on a daily basis. Let's go to a daily chart. On a daily basis, you can see in the fourth quarter of 2018, which should be, obviously the COVID is kind of its own thing, but there's the fourth quarter of 2018 right there. We closed near 125%, up to 100, just barely above it, 125.069. If you go out to 15 and 16, over here, it was actually at the beginning that we closed all the way up to 130%. At the very beginning of that run, and then 2011 we also closed at the beginning of that run well up to 126%. So I expect we'll get to 125%. Again, obviously not at the beginning of this run, which means like 2018 will most likely occur at the end of the run by the time it's all said and done. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that tell you why you're either a lot more bullish than I am or that you're a lot more bearish than I am? Share with us down in the comment section down below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today, and you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What stood out to you from today's video? What questions or comments do you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Remember, you also have that one-time sale that, again, we won't do again for another 100 years if we're still around in 100 years. It's our biggest sale that we will ever have. We haven't had a sale anywhere. We haven't had a sale as big as this before. We won't again. So be sure to take advantage of that. Also, follow me on Twitter for more content in between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, some of the things that you get as part of being, there's our plan up there. Some of the things that you get for being a premium subscriber, among other things, is access to our Market Outlook live video. This video right here, if you click on that, it takes you to this page. This is where we review all the trades we've done in prior Market Outlook videos to see whether we should stay in them or get out of them. We also put on today's trade idea already, the one that you hear at the end of the video. We already put it on today before the market closed. We did it during that live video. You can also get to it by clicking on live trade review. You also get access to all of our trading rooms and Q&A sessions. Brandon's Q&A sessions tomorrow. If you click on view more, you can see the calendar. You also can see 4 years worth of recordings, almost 4 years worth of recordings here in all of our upcoming classes. You can also get to this page by clicking on trading rooms. Come down here to the bottom. You can see, like, what you can also see too. All of our new subscribers are checking out all the charts, all of our charts that we use. You get access to those and how to set them all up. So you can see it again. That's one of our popular posts right now for good reason, because of who was signing up there. Come over here, click the heart icon. That takes you to this page. Hit that like button. Also click on this thumbs up icon. It takes you to this Facebook page where you can hit on that like button there as well. Again, the more you do that, it helps get our content out to more of our followers. That's the way their algorithms work. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, if we take a look at how the price moved here today, what drove, you can see the Qs were down the most, down 2.5%, IWM down almost 2%, U.S. stocks really getting hammered relative to international equities, which are only down about 1%. Actually, international equities outpace U.S. bonds. You can see long-term bonds continue really to drop down. Real estate is down pretty big. But you can see on the other hand, commodities still remain strong. Gold is still doing very well. The dollar was up today, as well as high yield bonds outpacing treasuries, which is not what you would expect on a day like today. If you go to the week, this whole week here, the 2 days that we've had so far, you can see very bearish for U.S. equities and for that matter, international equities. Bonds, most of its losses were today. Commodities really, really doing well. If I were to go back to this past, let's see here, let me pull up this chart here, and let's go back to, when did this near-term selling start? It looks like it started on the 17th. So let's go back there to the 17th and see when this last leg of selling really started. And you can see it's, again, IWM and the Q is both down 6.5 to 7.5%. The S&P 5.5, international equities down 4%, 4 to 4.5. So outpacing U.S. equities, but not by a lot. And you can see the dollar is up really strongly over the past however many days. Gold is up, commodities are up, long-term bonds are up despite their drop here today. So you can see kind of a risk-off mode when you have gold, bonds, and the dollar moving in the same direction. In this case, you also happen to have commodities, which is pretty rare. But of course, we know why, right? This is kind of really driven by what's going on overseas from a geopolitical standpoint and how that's impacting markets. You can see how it's impacting things here among the major economies. Look at Russia. You can see the big gap yesterday. coming out of the holiday weekend, and then following through with that with another 9% drop today. Big drop in Russia here. Not so much in everything else. So Korea, remember, is a proxy for global economic growth expectations, and it's actually not below that low point from when this be the 27th. I remember a lot of these others are. So the U.S. is flirting with that low. China is below that low point. Japan's not. Germany is. The U.K. is actually holding up very well from a relative standpoint. France is below that low point. India is looking to get below it. Italy is looking to get below it. Brazil is just killing things right now after being such a big decliner, kind of like what Russia is now. But now it's actually up 13%, by far the biggest amount up over the past 3 months. And then you can see Korea not quite below that low point either. So pretty, dark pink shading and a red line for most everything. Not quite there for Canada yet, but pretty darn close. It's at 52. And then this is the UK and Brazil that are the two outliers in either direction. Kind of interesting to see that move. If I take a look at the sector grid, the U.S. large cap sector, dark pink shading and red lines all across the board. The only one that's not is energy, and it's got light pink shading, right? So it's got a green line and light pink shading, but everything else is really, really bearish. Discretionary's got a cluster today. Communication services got a cluster today. The real estate is getting multiple clusters here lately. You can see the big breakdown in utilities. I mean, industrial's got a cluster today. This is a pretty decent breakdown across multiple areas. You can see discretionary is below that low. Communication services well below that low. Industrial is below that low. Financials aren't. Energy obviously is not. Materials flirting with the utilities and real estate both below those lows. Staples are holding up pretty well, and healthcare is not quite below that low point either. Let's take a look at some charts of these different asset classes. Let's take a look at long-term bonds. You can see the drop back below the 8-day moving average, though you notice its MACD is still above its moving average. So we're actually still in a bearish convergence mode. We're below the point of the value area. We are in a death cross environment for long-term bonds, so keep that in mind. If you look at it from a long-term, from a weekly perspective, you can see we're actually below. We actually already have corrected on long-term bonds. This is the 15-200 week, right? So you can see how even when the gap is really big, the gap can fill. And long-term bonds have done that throughout the end of 2020 into the beginning of 2021. And now we're a little bit below that and trying to figure out whether it's going to hold this support at the 62% retracement and bounce back up or not, right? You can see the MACD histogram is moving higher to the upside. Bitcoin, on the other end of the risk spectrum, you can see Bitcoin is just starting a corrective move. You can see it's in a death cross environment, just barely. After having broken the 200-day, the 50 is crossed below. We did retest the 50 after the 50 crossed below, and we're back down. We are below the one. So the year's volume, 70% of this past year's volume is above us right now. And you can see the significant. If we were to break this 37,000 whatever, you can see how significant that would be, and why. I mean, there's not very much volume down below it. It's going to be very, very easy. Got a little bit of a double top type formation. Very easy for it to come down to these levels, knowing that there's not even a whole lot of support at that 30,000 level, which is the last touch we had post-COVID at that 62% retracement. If we take a look at commodities in particular, let's take a look at crude oil. Crude oil has been the biggest beneficiary of these issues that are going on. You can see it's almost up to $100 a barrel. It's above the 8-day moving average. It's above the 30. I mean, everything. It's a very strong bullish trend right now. If you take a look at the weekly version of this chart, take off the that move that we had here. It kind of throws off the scale. Remember when we went actually negative on the crude oil contract? But we'll take that off so it doesn't throw off the scale of the chart. And you can see this is the weekly version. Again, we had a pullback here in November, October 2021 when the rest of the market pulled back, but then we've been on a nice good rally on commodities and crude oil since then. And you also see it's not just crude, but now it's gold, and gold is really breaking out. In fact, it's breaking above a very important technical level here. Obviously, well above these moving averages on a weekly basis, but getting above that 23% long-term retracement is very, very important. It's a new high. It's a breakout. Very strong move. Now we're losing some momentum, so we're probably going to retest some of these moving averages in the short term. But very, very good move for gold prices. That's kind of coinciding with the Euro US dollar basing here. It's not making the move yet, but you've got a little bit of a kind of a inverse head and shoulders pattern, looking like we might be forming that the other shoulder, the right shoulder here, and see, we'll see how that ends up turning out. Here's and we are below the 8-day and 17-day, though the MACD is above its moving average there. So we are in this kind of convergence mode, very typical of a basing type pattern. And getting back above these lines would be very bearish for the dollar and very continue to be bullish for gold. All right, now let's take a look at our trade idea of the day. And I want to take a look at the financial sector and the banking stocks in particular. Let's take a look at JP Morgan. Big breakdown today. It was trying to get back above its 23% retracement, but instead failed and got dark pink shading in a red line, the intermediate line breaking back below or getting into bearish territory here pretty soon. Very bearish near-term peak there. We've talked about those before. We're 2.5% below the moving average, so we are significantly enough below to stay below the moving average there. When you take a look at the long-term view for JP Morgan, you can see we are in a death cross environment there with the 10-week below the 40-week, back to a bearish candle after some more neutral candles there, falling PPO level. Let's take a look at the 3 green arrow chart. You can see that the histogram is dropping, just barely turned red. The stochastics is dropping out of bullish territory. We're back below the point of control, getting below the value area. We're already in a death cross there too on the daily 50 and 200-day moving averages after failing at the 50. So a pretty significant breakdown there. If you take a look at some of the other oscillating charts, you look at the DMI, you can see we're breaking back above 25. The positive indicator breaking back below 20. So the ADX, which is low, is starting to rise again. Looking at the RSI and the CCI, you can see they're breaking it towards bearish levels, back below minus 100, working towards being below 40. Looking at the Ichimoku cloud, we're still easily below the cloud. We're still in a noisy level on the weekly basis. Here's the daily basis. On the weekly basis, you can see we're just filling in the cloud. So we actually have some room really that we can move on JP Morgan before we even get to the bottom of the cloud there on this corrective level. It's very similar when you look at the moving averages here again, but this time looking at it on a weekly chart. Pull up JP Morgan there. You can see there's a lot of room. There's not very much volume below us. There's a lot of room down. If we are actually indeed in correction mode and we make a run back towards that 200-week moving average, there's a pretty decent amount of room for us to work our way down there. Taking a look at the Bollinger Bands, and actually let's look at the Keltner channels with the Bollinger Bands. Let's go Keltner channels there. JP Morgan, you can see, whoops, sorry, not that one. I want to look at the squeeze there. You can see we are back into the lowest quartile. We've had red dots, so the bands are back in, so the bands are setting up for a new breakout to the downside, and getting into the quartile. Lowest quartile sets you up for that. Here's the whole moving average. And you can see the change in direction. We're back to bearish a few days ago. We're continuing with the bearish candles here today on the daily chart. We got a bearish crossover being below the 200. See, this crossover occurred above it. In fact, we had a green line again when we had that crossover. And you can see some of these other crossovers here occurred when we were above it. This is one that's occurring, or actually below a falling 200-day hull. So pretty bearish pattern, especially getting back below this 23% retracement level and working our way back down towards 38% or more if we were to really continue to, again, to have a correction in these stocks like we're having in some of the other stocks right now. So what I decided to do on that stock is look at doing a long call option. You can see going out further in time, doing a long call option here, a long put option, buying a put, setting your stop order at 50%, keeping my risk at $1,000 if it doesn't work out. That way, if it does fall down, and you can see by June expiration, the current volatility says it can get all the way down to 120. Well, that actually happens to be where that 23% retracement level is, right down here, this 120, 122 level, and the 62% retracement. So if we were to touch down that level, we're looking at about almost $4,000 reward for, like I said, $1,000 of risk if we were to get stopped out. Of course, if we were to roll around and roll back up, then we don't have to wait to get stopped out, right? If we get back above this 156, 157 area, then at that point we're losing about $800 instead of $1,000. So I just take that loss. So now $4,000 reward for an $800 loss is much different, and that's if we were to roll over right now. Obviously, if we were to stay down and then roll over later, then we might end up taking a much smaller loss than that. So that's the idea behind that trade. Again, buying at the money strike and then putting a stop order there, as you can see here, at 50% of what you purchase it for. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have there. Reply to anybody else's thread. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Also, join our website at marketscholars.com. You got that special offer, one-time unique offer that we're doing to take advantage of that I talked about earlier. Also, like us on Twitter and Facebook. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.